Okay, so what are the other rules that we need to be aware of? Well, let me take you through them. First of all, once you obtain competency, diversification is actually undesirable. Now, let me explain what I mean by competency. That means where you're getting a fair degree of accuracy. Why is this relevant? Well, remember I said, with charting, we're probably only looking at having 3 or 4 open positions at a time. And that means you're necessarily not particularly well diversified. That being the case, that's what I mean when I say that once we've got a degree of competency with charts, then diversification probably isn't that vital. Okay, that takes care of that. Now, risks. Risks are controlled by care in the selection of the stocks we make and a large cash reserve. Now, what I mean by that principle is simply that what we're going to do is use the price charts, use the knowledge and know-how we have about probabilities of trades moving higher, etc., in order to ensure that we don't get caught out by taking too great a risk. I know we're having 3 or 4 positions open at a time, and that seems undiversified, but since we're going to be careful in selection, that removes the risk problem, and it is so much about risk. Okay, decide at what point you will know things have not worked out. I've made this point before, and I kind of keep on making it. Risk is the difference between the cost and the sell point. Risk ought to be far less than the profit. Now, what I mean by that is, the point at which you know you're wrong, and however much money you could lose, whether it's $20 or $100 or £20 or £100, you must make sure that the profit that you're aiming for is far greater than that. It seems basic, you'd be shocked how many people simply get that principle wrong. What they do instead is they hold on for a very small gain, and they will wait for huge losses and risk huge losses to get it. It's just the way they work. Okay, you've got to know your outcome. Develop a plan of action and reevaluate. I'm going to show you how to do this step by step. Homework, hard work, and discipline, I'm afraid, are the 3 things you're going to need in order to be successful at this charting game. Fine. Now, this is the really important bit before we get on to specific charts and specific examples that I'm going to show you. And there's quite a lot of charts we're going to be looking at. Before we do that, one thing I want you to remember is the next few things that I'm going to talk about as we talk through these charts. Several principles. Assume, for argument's sake, 7 out of our 10 trades are correct based upon the charting principles we're going to learn. Now assume that on average we get a 20% return if we're corrected. Now remember, I know I said we only enter a trade if we expect a 30% return, but let's assume that in effect we only get a 20% return on all the trades that are correct. 7 out of 10 trades are correct. Of those 7 out of 10, we get a 20% return on the money we've invested. If we invested £10,000, we get a £2,000 return, and so forth. That's simple and straightforward enough. Now I want you to make another assumption. Assume that when we're wrong, our maximum loss is 25%. So 7 times out of 10 we're correct. Of those 7 times out of 10 when we are correct, we make a 20% return each time. 3 times out of 10 we're wrong. When we're wrong, we lose 25% of our money. Now, anybody will tell you that 0.7, which is 7 out of 10, multiplied by 20, that's our 20% return, is greater than 0.3, 3 times out of 10 we're wrong, and the 25% loss we make. In other words, as a matter of simple math, if using charting we can be right 7 times out of 10 and get a 20% return, and we're only wrong 3 times out of 10 and we get a 25% loss, then overall, as a matter of mathematics, we should be profitable. This is our trader's business plan, and I want you to look at this and try to understand it in the bigger scheme of things so you get a feel for what we're trying to do. Why do we look at charts? We look at charts so we can be right 7 times out of 10, not 5, not 2, not 1, 7. That we can try and get a 20% return when we're correct, and that we only limit our losses to 25%, and that we're only wrong 3 times out of 10. Why are all those things important? Well, without them, we're not going to make our returns. Now I want you to make another assumption for the moment. Assume the total original capital that you have is £60,000. Okay, let's move on for a second with all those assumptions in place. What's the value at risk? In other words, in any one trade we make with the assumptions I've just given you, how much are we risking? How much could we lose? Well, with the money that I said we had in our portfolio, assume you make £12,000 bets per trade. In other words, you invest £12,000 per trade in your portfolio. Therefore, the risk per trade is the 25% that you can lose if you're wrong of the £12,000. So it's £3,000. Do you see? The most you can lose is 25%, we said. Let's assume that. If you're betting £12,000, then that's £3,000 is what you can lose. That's 5% of your original capital. Now that's important to know because it actually puts a figure on how much sleep we're going to lose. If we're wrong in a position, you're going to lose 5% of your original capital. Now if you think that's too much, then what you've got to do is reduce your trade size from £12,000 to 10 and so forth, because that gives you a very good idea of how much you might lose. And these figures are very important to know. The problem is most private investors don't have a clue. They just trade by the seat of their pants. They don't realize that these things are so important. Okay, if you have a maximum of 4 open positions at any one time, then the maximum value at risk is obviously 4 times £3,000, which is £12,000, or 20% of your capital. In other words, what happens if you have 4 open positions and all 4 went the wrong way? You just got a really bad piece of luck. Well, what would happen is you could lose 20% of your total capital. Again, if that's too rich for your blood, what you would do is you might only have 3 positions open at a time. That way, the most you can lose is £9,000, or 15% of your original capital. Now, do you see why it becomes very important to get an appreciation of how much we're risking, how much we could lose, where we stand at any given time? It makes for far better sleeps at night, I guarantee you. But not only that, what also is important is this is why we're looking at the chart. To make sure when we look at price charts, we only get 25% maximum losses when we're wrong. Now, let's move forward a little bit. Well, that's fine. That's value at risk. What about annual profit forecasts? Well, annual profit forecasts work a little bit like this. Let's say, what's your expected profit per trade? Well, 7 times out of 10 you're right, and you make a 20% gain on a £12,000 trade. That means you should be making roughly £1,680. That's your expected gain. 7 times out of 10 you're right, that's 0.7. 20% gain, that's 0.2. Times £12,000, that's the amount of money you place per trade, that's 1,680. Take away that from that your losses. Your losses are 3 times out of 10 you're wrong, 25% loss times £12,000, that's £900. On average, your expected profit per trade is £780. That's on average per trade. Now, that doesn't mean you're going to make that much. What it means is on some trades you'll make more and some less. But this is just a mathematical depiction. It's a simplification to give us some idea as to whether our business plan works, whether all this charting and all the effort we're about to go into is worth our while. Expected profit per trade is therefore £780. Therefore, your net profit margin is 6.5% per trade. That's just 780 over the amount of money you're risking each time. Fine, that's just a side issue. What else is important is, what's your net annual profit? Well, it's 780 times the number of trades you can expect to make in a year. If it's 30 trades, that's £23,400, which means a 39% per annum net return on your original capital. Remember what your original capital amount was? We said 60,000. So it's 39% per annum. That's if all these figures work out. Now do you see why it's so important to make sure we're right 7 times out of 10 and so forth? Well, what are the key factors that we're using charting to make sure that we have? Well, first of all, the number of trades per annum. We're going to assume that's constant. The probability of a successful trade. Well, that's 7 out of 10 using charting. Percentage return for a correct trade, we've said 20%. Let's assume that's correct, and we're assuming that's constant. The personal ability to stop losses, make sure we get out at 20%. And the return per trade, well, that depends on how much money you bet, and that depends on your total capital. The willingness to hold funds uninvested, awaiting real opportunities, is a real key to success. If you're wrong, the opportunity will return later. Cash can be comfortably held for a long period. I hope that's made sense. There's a lot of information there. You might want to rewind and go through that module again. Going forward, we're going to look at specific charts. That's in the next chapter. For now, digest what you've learned in the one that's just gone by.